There's a massive shift happening right now. We are watching a journey from the absolute Wild West chaos of crypto day trading straight into the quiet, highly regulated boardrooms of institutional finance. Today, in this explainer, we're going to uncover exactly why retail traders constantly get wiped out, and then we're going to explore the specific asset that analysts say is actively building the infrastructure for the world's digital money. But first, I gotta ask you a question. Have you ever felt like absolute prey in the market? You know the feeling, right? Like the exact second you hit that buy button, the price instantly tanks. It's almost as if the whole system was designed specifically to liquidate your position. Well, you aren't imagining things. Okay, let's dive into this. Here is our roadmap. 1. Market maker traps explained. 2. Outsmarting the market. 3. The institutional pivot, Quant. 4. Tokenomics and supply shock. 5. Quant technical analysis. And finally, 6. Future price predictions. All right, starting with number 1, market maker traps explained, predator versus prey in crypto trading. Look, crypto is a wild space. 20% swings, completely routine. But when you actually dig into the data, you realize those moves aren't always organic. They're often highly calculated plays by algorithmic firms and whales to control price action. It turns out this predation is incredibly systematic. Analysts have pinpointed 5 clever traps you need to watch out for. First, you've got fake breakouts. That's the classic retail bait. The price pushes past resistance just long enough to get retail to buy in, and then boom, it reverses. Then there are stop hunts, which are sudden liquidity grabs to fill large whale orders. Range traps are designed to just chop up traders in tight, boring zones. Inducement moves slowly tempt weak entries before flipping the script. And of course, the granddaddy of them all, news manipulation, pure hype and dump. This creates a massive disconnect. What retail sees is a breakout. They see a massive green candle. The FOMO kicks in and they jump in. But what market makers are actually doing in that exact moment is using that fresh buying liquidity to quietly dump their own massive bags. Or they're triggering stop losses, which immediately sends the price crashing right back down. It's a trap. Number 2, outsmarting the market, navigating the chaos. So how do we stop being the prey here? How do we use data to navigate this chop without getting completely wrecked? Well, to give you a sense of the stakes, a recent market liquidation event wiped out a staggering $700 million. Yeah, $700 million gone in a flash. That is the very real, very painful cost of trading purely on hype and emotion instead of relying on the data. But the data does give us an edge. To outsmart these algorithms, analysts recommend 3 really strict rules. First, always check volume and on-balance volume, or OBV. If a price is breaking out but the volume is completely flat, yep, it's a trap. Second, verify the move with indicators like VWAP and ATR. That ensures you aren't buying into an overextended fakeout. And third, when major news breaks, just wait. Seriously, waiting 15 to 30 minutes lets the algorithmic manipulation shake out before you commit your hard-earned capital. Let's move to section 3 and see how this builds into our next point, the institutional pivot, Quant, from speculation to utility. See, if day trading is just a game of predator and prey, the only real antidote is finding assets rooted in actual undeniable utility. And that brings us directly to the Quant Network. I absolutely love this quote from our source material. This is not about quant to the moon anymore. It is about being the plumbing for the world's digital money. That hits the nail on the head. This captures the exact shift happening right now. We are moving far away from silly meme coin speculation and pivoting towards serious, highly regulated institutional infrastructure. So, what does this plumbing actually look like in practice? Well, Quant operates the Overledger OS. Think of it as an operating system that allows completely different, isolated blockchains to actually talk to each other. And the real-world integrations they're pulling off are staggering. They've completed testing for SWIFT ISO 20022, that's the new global standard for financial messaging. They're deeply integrated into the UK's global banking tokenized deposit project, basically acting as the bridge for digital sterling. Plus, they just launched Treasury as a Service, letting massive enterprises secure their private networks. Guys, this isn't retail hype. This is the literal bedrock of future banking infrastructure. Which leads us to number 4, tokenomics and supply shock, the scarcity engine. You might be wondering, why does all this enterprise plumbing matter for the token price? It all comes down to one word, scarcity. Quant has a permanently fixed supply of roughly 14.6 million tokens, period. That's it, and almost all of it is already circulating in the open market. So the crucial point is this. Unlike so many other projects out there, there's absolutely no inflation here. No endless token emissions. No massive staking rewards flooding the market every single month. But here is the real kicker. When these massive banks and enterprises want to use the Overledger network, they are literally required to lock up QNT tokens to purchase their licenses. That means every single new enterprise client removes tokens from the open market. It creates a structural, undeniable supply shock as the circulating supply gets tighter and tighter over time. All right, moving to number 5, QNT technical analysis, finding the support. Keeping that massive macro utility in the back of our minds, where is the price actually sitting today, and what are analysts looking at in the near term? Just a quick reminder, this is analyst data we're looking at, not financial advice.
Looking at the critical levels they've mapped out, primary support is holding strong around $68.22. This is a massive order block where buyers have consistently stepped in with high volume. Now, if that level breaks, the secondary support and major demand zone sits down at $64.77. On the upside, Quant faces an immediate near-term resistance at $68.80, but the main target for a real breakout is the heavy seller liquidity sitting up at $71.73. Analysts are watching these zones like a hawk, waiting for real volume confirmation so they don't fall for those fake-out traps we talked about earlier.
But, as we all know, no altcoin exists in a vacuum. QNT currently has a massive 0.85 correlation with Bitcoin. Basically, if Bitcoin sneezes, altcoins catch a cold, right? Analysts point out that if Bitcoin breaks down below $77,000, it'll likely drag Quant right down to that $64.77 support level. Conversely, if Bitcoin breaks up past $79,000, that's exactly the momentum QNT needs to go test that heavy $71.73 resistance. And finally, number 6, future price predictions, the analyst outlook from 2026 to 2030. So what happens if we zoom out? If we look past the chaotic daily charts and project out based on that institutional adoption and fixed supply? Let's take a look at the long-term scenarios compiled by industry analysts. And this brilliantly illustrates the long-term potential. The data reveals a pretty wide range of outcomes. By 2026, conservative estimates place QNT between $180 and $250. But optimistic models, the ones assuming rapid global enterprise adoption, push that all the way to $450. Looking even further to 2030, analysts project a conservative baseline around $800. But in an optimistic scenario where Overledger literally becomes a global standard, predictions reach upwards of $2,500. It's a staggering projection, though it's important to remember it relies entirely on real-world corporate execution. But perhaps the most telling piece of data we have right now is what is happening silently beneath the surface. While retail traders are out there panicking over market dips and extreme fear indices, on-chain data shows something else entirely. Large wallets, we're talking accounts holding between 100,000 and 1 million tokens, are quietly and actively accumulating QNT during these dips. The smart money is literally buying the fear. Which leaves us with the ultimate question to wrap up this explainer. When you look at the crypto market today, are you just trying to dodge the next trap and trade the hype? Or are you zooming out to look at the underlying plumbing of the digital economy? Because that is the difference between being the prey and understanding exactly where the entire system is heading next.